Good day. My name is Rossouw and I'm a portfolio manager with Adviceworx Private Client Securities. I'd like to spend the next quarter of an hour talking to you about the global COVID-19 pandemic and the impact that it's having on investment markets. I'd also like to share some thoughts with you on how Adviceworx sees the way forward. In the United States, the two contenders in last month's presidential election seem to inhabit parallel universes. President-elect Biden is putting in place the top structure of his administration and formulating policy, even as President Trump refuses to concede and continues to claim massive electoral fraud. This saga should hopefully come to an end on the 14th of December when the Electoral College formally elects the next president. As of last night, more than 65 million people have been infected with COVID-19 and more than 1.6 million people have succumbed to the virus. The United States remains hardest hit with over 14 million infections and more than 280,000 deaths. India, Brazil, Russia and France make up the top five, and the United States remains the epicenter. South Africa is thankfully down to 16th position in terms of recorded cases. The lockdown measures introduced in Europe seem to be having the desired effect. Brazil and India are also seeing a slowdown in new cases. The notable exception is the United States, where more than 200,000 new cases per day were reported this week. The rising number of infections has led to an increase in the number of hospitalizations, and more than 100,000 Americans are now in hospital suffering from COVID-19. As can be expected, an increase in new infections will ultimately result in a rising daily death toll. Most countries battling the second wave have managed to flatten the curve, and to this extent, the number of daily deaths is also coming down slowly but surely. Again, the United States is the exception, where this week for the first time daily deaths surpassed 2,800. Experts warn that that can rise to over 3,000 before things improve. Britain and the EU have suffered economic reverses on the back of the second COVID wave, and this has undermined business confidence. According to the IMF, global GDP should rebound by 5.2% next year, and the strong performance of the Chinese economy will no doubt play a major role in this. In the United States, the strong recovery in retail sales has not been matched by a similar rise in demand for services. German unemployment remains stubborn, and global trade volumes remain subdued. These two graphs depict the purchasing managers' indices and economic growth numbers for the Eurozone and the United States. Americans seem to be much more sanguine about the second wave than Europeans. In the third quarter, the increase in the number of new infections resulted in Eurozone PMI dropping off sharply, whereas in America, where the third quarter saw strong growth, the PMI number is still improving. One of the main reasons for America's superior economic performance of late is the fact that the US federal government has been much more aggressive in providing fiscal stimulus than the European Commission. This has seen the US budget deficit increase from less than 4% to more than 16% in the current financial year. There is a clear inverse correlation between the severity of the COVID-19 pandemic and GDP growth. Countries like China and South Korea, which have successfully arrested the spread of the virus, have suffered relatively small reverses and are recovering rapidly. Africa and the Middle East have also been relatively unscathed. Europe and Latin America experienced major economic contractions, and the worsening COVID crisis in the United States will probably impede its recovery. Major economic shocks tend to slow down the growth in international trade. The recession which followed the global financial crisis of 2008 saw the long-term trend come down significantly. The COVID-19 pandemic has introduced a new headwind, and trade volumes for 2020 will probably be no higher than those for 2016. Next year's number is unlikely to surpass 2017's. Global equity markets enjoyed a stellar month in November, and a number of indices set new records. The optimism about COVID-19 vaccines will probably propel markets further upwards. The US dollar remains under pressure as risk appetite increases, and the rise in the oil price has slowed down somewhat. Now that the global economy seems to be on the road to recovery, industrial commodity prices are surging, even as that of gold is slipping. Most global markets rallied in November, and some indices have posted impressive year-to-date numbers, among them the Sensex in Mumbai, the Shanghai Composite Index, the S&P 500, and the Nikkei 225. In Europe, however, the gloom over the second COVID-19 wave has weighed on markets, and the FTSE 100 in London, for example, is down over 16% year-to-date, and the CAC in Paris more than 8%. Another pleasing development in the past month is the reduction in volatility on equity markets. The VIX, the S&P 500 Volatility Index, has come down from a high of over 80 to a low of 20.5 at the end of November, which is its lowest level since the 21st of February. The onset of the COVID-19 pandemic saw a dramatic reduction in the global demand for crude oil. At the same time, disagreement among oil-producing countries saw overproduction and the price collapsed. Many countries used this as an opportunity to build up their inventories. Of late, increased demand and reduced production has seen the oil price rise to above $45 per barrel again, and this trend is set to continue. The likelihood of COVID-19 vaccines becoming widely available in the near future has cheered most markets, including those for industrial commodities. The prices of all of these commodities have risen sharply in recent times, including coal and oil, which have been the perennial laggards. The sole exception is the gold price. Gold seems to thrive in times of uncertainty, and the return of optimism has been bad news for gold bulls. Thanks to a number of tailwinds, the global economy should return to health by the second quarter of next year. The recent run in global equity markets will probably continue, but the gains will no longer be limited to the technology sector only. This more settled environment should be good for emerging market equities and bonds, but not so good for alternative assets like gold and cryptocurrencies. Here at home, public sector trade unions have taken government to the Labour Court over its failure to implement previously agreed to wage increases. Government argued that it doesn't have the money to do so because of the massive cost of the fight against the COVID-19 pandemic. The size of the public sector wage bill is one of the main reasons why our debt to GDP ratio is rising sharply. More than half of the annual budget is spent on the salaries and benefits of around 2 million state employees. As of last night, more than 800,000 South Africans have tested positive for COVID-19, and nearly 22,000 people have succumbed to the virus. The sharp rise in infections and hospitalizations in the Eastern Cape has resulted in the Nelson Mandela Bay Metro being declared a COVID-19 hotspot, and stricter lockdown measures have been imposed there. The Southern Cape Garden route, where infections are also surging, will not face a stricter lockdown for now. It is clear that government wants to avoid using blunt instruments like a national lockdown again. The Business Confidence Index improved during the fourth quarter, but it is still not back in positive territory. The Absa Purchasing Managers Index remains positive, however, and South Africa's trade surplus grew in October. Our junk status means that government bonds incur a rising risk premium, and a higher wheat price is bad news for consumers. South Africa's trade surplus grew by 3 billion rand from 33 billion in September to 36 billion in October. Even though the recovery in economic activity saw imports, depicted by the green line, rising, this was more than offset by an impressive increase in exports, depicted by the dark blue line. The Absa Purchasing Managers Index remained in positive territory last month, but the overall reading was down on October's impressive 60.9. The main reason for the lower PMI was concern over the economic impact of a second COVID wave. The two areas where this was reflected most acutely were business expectations and new orders. The readings for output and employment were little changed. The term risk premium can be defined as the extra return investors demand from a risky asset in order to hold it, rather than a risk-free one. Over the years, South African bond yields have had to contain a growing risk premium relative to the average for emerging markets. This reflects a worsening perception of our governance and fiscal policy. Under President Mbeki, the risk premium averaged 1.53%. Under Zuma, this rose to 2.71%, and it is currently around 3.83%. November was a great month for the JSE. The all-share index rose 11%, led by a surge in the banking sector. Listed property remains bombed out, though. Bond yields have weakened in recent times, and this was inevitable given recent outflows of foreign capital. The weaker dollar meant that the rand-dollar exchange rate remains firm, and JP Morgan sees locally focused shares as a buy. Financials were the best performing macro sector on the JSE in November, but for the year to date it is the only one of the three in negative territory. For the year to date and the past 12 months, the sector is still down by more than 25%. Listed property and financial services were the worst performing subsectors. After a number of positive weeks, last week saw net foreign selling of South African securities. The bond market experienced an outflow of 1.1 billion rand, while the JSE lost 2.13 billion rand. The combined outflow from these two markets currently stands at just below 190 billion rand for the year to date. The rand, depicted in dark blue on this graph, seems to have shrugged off the recent ratings downgrades and keeps on firming against the US dollar. It is currently trading at levels between 15 Rand 10 and 15 Rand 20 to the US dollar, and this makes it one of the best performing emerging market currencies relative to the greenback, along with the Indian rupee, the Indonesian rupiah, and the Chilean peso. Looking ahead, we expect the advent of COVID-19 vaccines to inspire economic normalization. This should see currently unpalatable sectors attracting investors once more. Monetary policy is likely to remain expansionary with interest rates remaining low. There is definite value to be found in the local equity market, but the underlying economy needs to improve for this to be unlocked. The rand is starting to look overvalued, and the rally in local bonds could eventually be undone by fiscal weakness. The Adviceworx PCS asset allocation view can be summarized as follows. Because of the economy and the weak rand, we remain overweight global equity and underweight South African equity. We remain neutral on global property where valuations are reasonable, but negative on South African property. We hold no global fixed income, and we remain overweight South African bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make sense of them. Should you have any questions or queries, please don't hesitate to contact me or your Adviceworx financial advisor. I hope you'll have a lovely day and a splendid weekend. Until next week, goodbye from me.